The entire world is screaming about an upcoming stock market crash, but here's something even scarier. What if the stock market doesn't only crash, but also freeze for one day? No trades, no price changes, no way to buy or sell anything. The global market freezes, and suddenly, trillions of dollars are paralyzed. This video isn't just about what happens when the market freezes or crashes. It's about what you need to do before the tragedy hits. Because by the time the panic starts, it's already too late to prepare. Part 1. What if the stock market froze for one day? A stock market freeze means all buying and selling of stocks is suddenly stopped. It's like someone hits the pause button on Wall Street. No one can trade and prices don't move. Orders don't go through. Even one day market freeze can cause big problems. And here's why. Big investment companies called hedge funds use computers to trade stocks every second. If the market is frozen, they can't adjust their trades. That could lead to huge losses once things open again. In addition, currency markets where people trade money like dollars, euros, yen don't stop when the stock market does. So if stocks are frozen and money keeps moving, it causes confusion. People can't protect themselves from losses, and prices go out of sync. Also, there are special financial deals called derivatives like options and futures that depend on real-time market prices to work properly. If the market freezes, those prices stop updating, and no one knows what these contracts are really worth. That can lead to confusion, disagreements, and even big money problems between investors. So even if it's just for one day, a market freeze can confuse investors, shake up global trade, and cause ripple effects across the whole economy. It's not just a pause, it's a worldwide shock. Now let's look at some scenarios that could trigger a complete freeze. Massive cyber attacks could disable trading platforms across multiple exchanges. And these aren't theoretical. In 2023 alone, financial institutions reported a 150% increase in sophisticated cyber attacks. Sometimes big global events like wars, terrorist attacks, or major political instability can happen right in the middle of a trading day. If things get serious enough, stock exchanges might shut down trading completely to avoid panic and protect the system. But there's an even bigger concern. What if there's a massive technical failure that starts in one stock exchange and quickly spreads to others? That can create a domino effect to crash everything. Because today's financial systems are all connected, a problem in one place can trigger issues in others almost instantly. And if that problem is caused by a cyber attack or software glitch, it could be hard to stop once it starts. The probability? Low. Very low, but not zero. Now let's look at the crash scenario. Part 2. What if stock market crashes tomorrow? When we say crash, this isn't some routine dip in prices or a bad day on Wall Street. It's not the kind of thing where stocks go down 2% and analysts shrug it off with a, "that's normal." A crash is a sudden, sharp drop in stock prices across the board, often 20% or more, in just days or even hours. It's fast, brutal, and usually triggered by fear, uncertainty, or a major economic shock. Imagine logging into your investment app and seeing your $10,000 portfolio suddenly worth $7,500, then $6,000, then $5,000. Frustrating, right? But it doesn't mean your stocks are worthless. But in the middle of a crash, prices move so fast that you don't know what to do. And when value becomes uncertain, fear takes over. And fear is one hell of a market mover. Now let's talk about the impact of the crash situation. Every day, around 10 billion shares change hands just on US exchanges. That's roughly $700 billion moving around daily. And this constant buying and selling isn't just pushing numbers around, it's determining the actual value of these companies. But these markets don't just affect investors. They're the invisible hand touching nearly everything in your life. That retirement account your company set up for you, your parents' pension, the interest rate on your mortgage, the price of gas, all connected to these markets in ways most people never realize. So when we talk about markets freezing or crashing, we're not just talking about rich people's problems. We're talking about everyone's problem. Part 3. The immediate impact. The moment stocks crash hard, one emotion dominates everything: panic. Not because people understand exactly what's happening, but because they don't. When the market tanks, it's not just numbers going down, it's confidence evaporating in real time. It's like you're in a crowded theater and someone yells, "Fire!" Everyone sprints for the exits. Everyone can run, but in different directions, and trample each other along the way. That's the result of a crash. And every day, folks, maybe even you, are thinking, should I sell now before it gets worse? That's the chaos of a crash. The financial system runs on the idea that people believe in the system. Once people stop believing the market will recover or that their money is safe, it becomes a self-fulfilling prophecy. And with social media, that fear spreads like wildfire. A 2024 study showed that a single viral tweet during a crash can move markets faster than entire news channels could a decade ago. For regular people, it's not just digital drama, it's personal. Their kids' college funds, their retirement, that down payment. It all starts to feel like it's slipping away, and no one knows how much further it'll fall. Part 4. The economic chain reaction. This is where things get even more real. You've probably heard that everything in the economy is connected, and a market crash proves that in the worst way. First up, let's look at the banks. Banks often use stock holdings as collateral when they lend money to each other overnight. But if the stock market's crashing, the value of that collateral is dropping by the minute, which means banks start pulling back. They lend less, and when banks stop lending, businesses stop spending, hiring, and growing. If stocks are crashing, uncertainty starts to ripple through everything: energy, food, transportation, you name it. It doesn't end with just the US either. We live in a hyper-connected world. If US markets crash hard, Asian and European markets react within hours. A 2024 regulatory stress test showed that a crash in one major market could cause shockwaves in 80% of global exchanges by the end of the day. The modern economy is like a high-performance sports car, powerful, fast, and efficient, but fragile when any key part fails. Part 5. Could this actually happen? Well, why not? Markets have closed before. Just like after September 11th, US markets closed for 4 trading days, the longest shutdown since 1933. But that was planned and communicated. Everyone knew when trading would resume. Moreover, during Black Monday in 1987, when stock markets around the world crashed, the US Dow Jones dropped a record 22.6% in one day. It was triggered by panic selling, computerized trading, and fears of a slowing economy. The chaos was so severe that many stocks simply stopped trading because the systems were overwhelmed. More recently, technical glitches have caused brief freezes as well, and yet again, in 2025, everyone around is making assumptions about a brutal stock market crash. There's also a theory floating around that Donald Trump might be playing 4D chess with the economy, maybe even trying to cause a market drop on purpose. Sounds wild, right? So if this theory is true, we're not looking at the end of the world. We might just be seeing a short-term shakeup or maybe a global recession, one that's part of a bigger economic strategy. Part 6. What should you do before the next crash? Most people panic and sell at the worst possible time. The smart ones stay calm, invest wisely, and take advantage of the downturn. Take Warren Buffett, for example. While everyone was selling in panic during the 2008 crisis, he was busy buying solid companies at bargain prices. And then there's John Paulson, the guy who bet against the housing market right before it collapsed and walked away with over $4 billion. Yeah, while the world was burning, these guys were cashing in. Crashes might scare the crowd, but for the bold, it's a once-in-a-lifetime jackpot. Here's how to act smart in such situation. Step 1. Build a financial safety net. First, before you invest a single dollar in stocks, your first priority should be protecting yourself from emergencies. So what's an emergency fund? It's money you set aside in a safe, easily accessible place, like a savings account that you only touch for true emergencies, job loss, medical bills, urgent car repairs, etc. So, how much should you save? Aim for 3 to 6 months of your basic living expenses. That means rent, groceries, bills, transportation, and the essentials. Because if the market crashes and something unexpected happens in your life, you don't want to be forced to sell your investments at a loss just to pay your bills. If you have high-interest debt, especially credit cards with 8% interest or more, work on paying that off before investing. Why? Because no investment guarantees returns higher than 8%. But your credit card debt is guaranteed to cost you that much. You'll save more money by eliminating that debt first. Step 2. Invest when things are on sale. When the stock market crashes, it's scary, but it can also be a huge opportunity. Think of it like a sale. Imagine your favorite sneakers usually cost $200, but one day they're 50% off for no reason. If they're still the same sneakers, same brand, same quality, wouldn't you want to buy them at the lower price? That's exactly what happens in a stock market crash. Companies like Apple, Google, and Amazon don't suddenly stop being valuable, but their stock prices might drop because people panic. That means you can buy great companies at lower prices. But what if you're new to investing? That's okay. You don't need to be an expert to get started. Apps like Trading 212, Vanguard, or Fidelity let you start small and even buy fractional shares or small pieces of a stock. The most important thing is to start small, stay consistent, and don't try to time the market perfectly. Step 3. Stick to a long-term plan. You should use the dollar cost averaging strategy. It's a simple strategy where you invest the same amount of money every month, no matter what the market is doing. Example, you invest $100 every month into a stock or index fund. If the price is high, you buy fewer shares. If the price is low, you buy more shares. Over time, this evens out your cost and helps remove emotion from investing. But why is long-term thinking so important? Because short-term drops are normal. Markets go up and down all the time. For example, a correction is a 10 to 20% drop that often happens. A bear market is a 20 to 40% drop every few years. A crash over 40% is rare, but it has always recovered. People lose money when they panic sell at the bottom. The ones who stay invested usually recover and often come out ahead. Step 4. Diversify your investments. Diversification means not putting all your money in one type of investment. You spread your money across different types of assets, so if one goes down, the others might hold steady or even go up. Here are the main types of investments. Stocks, pieces of companies, can grow fast but are risky. Bonds, loans to governments or companies, safer but slower growth. Gold, precious metals, hold value during inflation or crisis. Real estate, property that can rise in value or produce rent. Crypto, very risky, but some see it as a long-term bet. You can also look into index funds, which are bundles of many stocks that track the market. They're easy to manage and great for beginners. Now think about dividends. Dividends are a thank you payment companies give you just for owning their stock, even if the price goes down. Some stocks pay dividends, cash payments, just for owning the stock. These can give you income even when the stock price is down. Part 7. Final tip. Stay calm, stay consistent. Most people lose money, not because the market crashes, but because they panic. Smart investors always keep an emergency fund, invest regularly, stick to their plan even when it's scary, diversify their investments so they're not overexposed. So, what do you think would happen if markets froze or crashed for a day? Let me know in the comments below. And if you found this breakdown interesting, hit that subscribe button for more financial explorations that won't put you to sleep. Whether you're just starting out or you've been investing for years, one thing is clear. It's not about predicting the crash, it's about being prepared for it. Don't wait until the panic starts. Start preparing today. Thanks for watching.